Now that we've prepared all these sub budgets for ACE, we can finally get to the task that we're asked to do from the get-go, which is to make their pro forma income statement. So I'm going to reference all these stuffs that we made in part one to work our way towards part two. The last thing that we are going to need for our pro forma income statement is COGS, which is really what we did all these sub budgets for, so we can make an accurate projection of what our cost of goods sold is going to be. So, what do we have here? What is our expected total amount of cost that we are going to incur? Well, we have direct materials used. We made a budget for that. So, going back over to the other set of budgets, our direct materials used is estimated to be a total of 45,000 for fashion frames, 8,000 for safety frames, and 17,600 for youth frames. So I can just add those three direct material costs for our three individual product lines together and get our total direct mat cost, which is expected to be 70,600. I'm going to follow that same process, going to my labor budget, add together the labor costs of each of the three respective models to get my total direct manufacturing labor costs. So going back over, we have our labor cost for fashion frames is 97,500. 17,000 for safety frames, and 38,500 for youth frames. That's going to come up to 153 grand. And for manufacturing overhead, one more time, we have a budget for that. Let's go to our MOH budget over here. We're expected to incur in total $25,000 of manufacturing overhead costs for fashion frames, 15,000 for safety frames, and 22,000 for youth frames. So all in all, during the period, we are expecting to incur $70,600 in material costs, $153,000 in labor costs, $62,000 in overhead costs. Well, you add all those numbers together, and our total cost of manufacturing goods is going to be $285,600. We're given in this problem that they're starting with $13,680 worth of cost in their inventory. So, what is their cost of goods that's going to be available for sale? Well, they already committed a little over $13,000 to cost before the period started. Add to that what we're spending this period, and all in all, we will have spent $299,280 producing finished inventory that we could have sold. But we're not going to sell it all because we are projecting or desiring to have units in ending finished goods inventory. So I got a little table on the side to calculate what the total amount of this, what portion of this amount over here is going to be tied up in ending FG inventory. Step one, let's go and find out how many units we're going to have in ending inventory for each of our three different models. So going back over to the other side, how many units are we going to have in ending inventory for fashion frames, safety frames, and youth frames, respectively? 2,500 for fashion frames, 1,000 for safety frames, and 1,100 for youth frames. So you can just take those numbers and bring them over here for my calculations. And how much in total will those units in ending inventory cost us? Well, at the bottom of the last tab, we figured out what our total manufacturing cost was per unit. And our total manufacturing cost per unit was $335 for fashion frames, $2 for safety frames, and $355 for youth frames. So if we go and bring those on over, I come up with a total of those amounts for each one. And now what I can do is just take the number of units we're expected to have in ending inventory and multiply it by our expected cost per unit. If those fashion frames, those 2,500 pairs of fashion frames, each cost us $335 to produce, that means our ending inventory would be carried at a historical cost of $8,375. And I'll do this for the other two models. I'm always going to take the units in ending inventory and multiply it by our cost per unit. Those 1,000 safety frames at $2 a piece is $2,000 that they'll be valued at sitting in our ending inventory. And for youth frames, same math, $3,905. So all in all, across our three different models, the total cost that we have in ending FG inventory will be equal to the sum of how much we're going to have in fashion frames, safety frames, and youth frames together. And that totals up to 14,280 bucks. So what is our cost of goods sold for this accounting period? Well, we could have sold $299,280 worth of finished goods. We just determined that $14,280 of that cost is going to be tied up in our ending FG inventory, which means we're projecting to sell the other 285,000. So we've gone through and we've accounted for all of our product costs, all of our costs related to manufacturing. Those costs have to flow through inventory before we can expense them, and we do expense them through cost of goods sold. And after all of these calculations, we've determined that our expected cost of goods sold expense that we're going to record for this period is 285 grand. But we have some period costs as well that we need to account for. We have product development costs, we've got marketing costs, we've got distribution costs. And in here, it's giving us a whole bunch of information about the number of units, et cetera, that we're going to have. But what we're really looking for over here is our cost in total. And our cost in total that we are going to incur across these three is 225,000 for product development, 300,000 for marketing, 125,000 for distribution, and 650,000 in total. So now I got to go through and make my pro forma statement. Let's start with the easy stuff that we already know. We know our cost of goods sold. We just calculated is going to be $285,000. We can bring that into our grid. We know how much we're going to pay in cost for each of our different models or not different models, different non-manufacturing costs. That's going to be 225,000 for product development, 300,000 for marketing, and 125,000 for distribution. Well, I got my expenses in there, but we're not going to have operating income if we don't generate some revenue. So now what I need to do is I need to go through and figure out what our expected sales revenue to be generated from each individual model is. We have our expected sales volume. We made a sales budget way back to start this thing off. So if I go back over that tab, our sales budget said that our expected sales of fashion frames was 50,000, safety frames 20,000, youth frames 22,000. So I can go and bring all of those figures in here. How much are we proposing that we're going to sell each one for? Well, that was given to us in the very beginning. So all the way back to the top table we started with, we sell fashion frames for 13 bucks, safety frames for 10 bucks, and youth frames for 11 bucks. So I can just go fill in those numbers and I'll type the other two in. It was $10 for safety frames and $11 for youth frames. And now my sales revenue is simply just my expected sales times my selling price per unit. 50,000 fashion frames at $13 a piece comes out to be 650,000. For safety frames, selling 20,000 of those at $10 a piece will generate $200,000 in revenue. And for youth frames, 22,000 of those at $11 a piece is $242,000 in revenue. And all in all, our net sales revenue from our three different models is just the sum of those three numbers. 650,000 plus 200,000 plus 242,000 is 1,092,000. Now I can fill this in. Firstly, we have one measure of profitability, our gross profit, which is just our revenues minus our cost of goods sold. If we are going to, line in there we go. We are going to spend $285,000 making stuff that we turn around and sell for 1,092,000. We have an insane profit margin of $807,000 of markup that's going to help cover our non-manufacturing costs, which is a good thing because they ain't cheap. So we'll have $807,000 to cover them, but we are going to have to pay the sum of these three numbers, 225,000 for product development, 300,000 for marketing, and 125,000 for distribution. That totals up to $650,000. So if we're paying $650,000 in total non-manufacturing costs out of the $807,000 in markup that we have, after we've accounted for both ends of operations, our product costs and our period costs, it's $157,000 in operating income that we are going to have remaining.